before you buy a stock, there are certain things to do to monitor so that you don't fall into a trap. You don't do a mistake. When you analyze a company, when you plan to buy a company, I suppose you have checked the fundamentals of the company. So revenue, earnings, growth. But one thing that differentiates the average investor from the great investor is to check the competitive advantage of a stock. So the first point, before you buy a stock, if you plan to hold this stock for the long term, you want to buy a superior business, which means you want to check the competitive advantage of a business. In other words, how is this business you're going to buy better than competition? What is the moat? You have different kind of moats. You have brand awareness. You have network effects, scale advantage. You have different kind of moats, pricing power, that will allow you to increase the revenue every year, to increase the earnings every year. Before you buy a stock, check if this business is better than average. One key metric to see if a business has a competitive advantage is to see the return on invested capital, ROIC. If you have a ROIC for the past 10 years that have been higher than 15%, it means they most likely have a moat, which means they are a good business, superior than competition. Because if they didn't have any moat, you can bet that competition from Silicon Valley, from China, will come to eat your lunch. So if you have a sustained return on invested capital for many years, it could be 10 years, but also 15 years, 20 years. If you have a sustained return on investment, that is very good news. It means you have a moat, you have some water around your castle, and competition can't hurt you much. And you can track this very easily. There are screeners on the internet that allow you to see the return on invested capital. You are not forced to calculate it. There are some tools online. You can use FinChat, you can use Stock Unlock, you can use GuruFocus. GuruFocus is free if you want, and you can check the return on invested capital, check if it's above 15%. So first is competitive advantage. Let me check my notes here. Okay, second point, before you buy a stock, obviously, now that we are talking about competitive advantage, you want to check the competition. It's a big C for competition. Who are the competitors? Who are the threats? Who are the sheep that you can eat? Who, for example, I'm taking the example of, let's say, a cybersecurity company. You plan to buy a cybersecurity company because they are growing nicely. Okay. In which segment of cybersecurity are they operating, and who are the main competitors? You may find one, two, three companies that are in the same area. Okay, check them. How do you check competition? You check similarly their revenue growth, their margins, their earnings growth over time, their return on invested capital. Because maybe everybody has a high return on invested capital, everybody is happy, everybody is nice, everybody is making a lot of money. Most of the time, this doesn't happen. This doesn't happen. Most companies are, don't want to say aggressive to each other, but there is a fight to get more market share. So most companies are not nice to each other and having a high return on investment. Somebody is always losing, somebody is always winning. You want to invest with winning companies, turnaround plays, or proven winners. And you can check competition, check their margin, check their products, are they better, check their moat. Maybe a competitor has a moat and will eat your lunch because they have a better moat than yours. Maybe that's the case. You never know what can happen. I've seen this example for cybersecurity. That's the reason it came to my mind. But yeah, you can take a lot of similar companies in the same situation and check the competition. For example, at the moment, a lot of people talk about Celsius, the energy drink company. I know the energy drink industry. You have Red Bull, Monster, Celsius, and other players, much smaller. So if you want to invest in Celsius Holdings, for example, a small beverage company that is growing fast, check the competition. Check Red Bull, Check Monster. Red Bull is a private company, so you will have great difficulty of finding the margins, the fundamentals. But Monster is a public company. Check the moat, check the margins, check how are your products different from Monster's products, and check the other players as well. How are you different? So competitive advantage and competition. Now you see it's getting more qualitative over time, because maybe you are in this situation of, oh, okay, you want to buy a stock because you like the fundamentals, but I'm asking you this question: have you checked the qualitative aspects? Because in the long term, qualitative aspects of a business matter as much as the quantitative side of the analysis. You can grow very well, but if the ship turns and it starts to decline, and the revenue starts to decline, earnings start to decline, this is based on a qualitative factor. Something has changed, and if you don't know who is the management, what are the incentives, who are the competition, how is my market evolving, you will not know what to do when things turn sour. And that's how you can lose a lot of money. You can do a stupid mistake like this. So check competitive advantage, check the competition. Let me check this. You want to check the potential guidance for future years. Let me put a G for guidance. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. What I mean is, some management will tell you exactly what their plans are for the next 5 years. We plan to reach this amount of revenue, this amount of earnings, we plan to have this range of operating margins, and we plan to deploy this amount of capex, capital expenditures, for future projects in Mexico and Australia. Okay, very well. Check this. Check if they have done it in the past. Check if in the last 5 years they have done what they said they would do. And if you can believe management and their past guidances, you can trust them with their current guidance and their expected forecast for the next 5 years. Check the guidance and see if you like it. You can always compare the guidance for the company you're going to buy with the guidance of other competitors to compare the industry. You will find some discrepancies, some gap in margins. But yeah, check the guidance. See if you can trust the guidance, if they have made promises 5 years ago and kept their word on these ones, and see if you like the guidance, because maybe they will show you some red flags, yellow flags, warning signs in their guidance, and the guidance may not be as good as you think. Okay, and that's also the reason why you stay in your circle of competence, because if you don't understand the guidance, you don't understand the industry, you will make a stupid mistake. So all this advice work very well if you are talking about a company inside your circle of competence. So I guess that you understand the industry, you understand the products, etc. We are talking about this advanced stage of of analysis. Check the guidance, check the potential risks. What could go wrong? Yeah, obviously. Let's say PR. Oh, potential risk. PR. That's not public relations. Public relations. That's potential risks. In other words, once you want to buy a stock, you see a rosy scenario, you see some growth, you like it very much, you fall in love with the stock. What are the 10 reasons that would make you lose a lot of money on the stocks? What could go wrong? And you take a Word document, a text edit, whatever you want, you list the 10 reasons what could go wrong and how, what will be the impact on future earnings, future growth. So I know it because I do it for myself, and for my students also. We also see this. When we buy a stock, we list, okay, this can go wrong and this may affect a little bit the top line. This can go wrong and that could potentially destroy the business. This can go wrong and this can go wrong and this can go wrong, and the list can go on and on. You can find 10 things that can hurt your business, but maybe 20 things, 30 things. And a pro tip is, the more potential risks you could find for a business, the more knowledge you have about a business, the lowest your risk, because you are aware of everything. And if you read a sell-side analyst report or something on the internet, and everybody mentions the same risk. Maybe it is priced in, but that's a bit more advanced for this one. So you can have an arbitrage play, but that's maybe for for another video. Check what can go wrong so you won't get disappointing. And maybe when you do your list of 10 potential risks, what could go wrong, you will find something that will make you upset. Say, oh, maybe this thing may destroy my business. Do I really understand the industry that well that I'm willing to take this risk? Because if you go into the, the cybersecurity industry, you like the stock, the management, the CEO, competition, moat, etc. This is, crypto, cybersecurity, AI. I don't know much about the industry. I don't follow it closely. Maybe these potential risks may disrupt the whole industry and you will lose a lot of money on this one. So this is small red flags for you before you buy a stock to get you more confidence in buying. If you don't like what you see for the potential risks that could potentially destroy your stock, is it a good time to buy right now? Is it a good time to buy right now, or should you really buy this business? Or should you move on and take a more simple business? That's a good question, especially since you buy this stock at a high valuation. And the last point, you're right, it's valuation. That's a good transition. The last point of the things to monitor before you buy your stock is the valuation, obviously. And if you do all this process, moat, potential risks, if you see some potential risks that could completely destroy your business, and if the stock is trading at a high valuation, you have some good risks here. You have some important move, and the stock, if there is a risk that happens, misguidance, etc. If there is a risk, the stock will crash 20%, 30%. I've seen this a lot of stocks that were trading expensively and they fall a lot. The valuation is like a rubber band. So the more you extend it, the more force you will get, the more velocity you will get. So if you buy a stock cheaply, a lot of bad news is priced in. Maybe if there is a bad news, it won't get much impact on the stock. That's fine. But if you buy a stock with high expectations, with a high valuation, everybody expects a rosy future for the stock. It turns out to be bad and you have a risk that nobody has seen, the stock can crash a lot. That's how you do a stupid mistake. So be aware of this risk and be aware of all the and be aware of all the risks that can happen for the business and for the valuation. I would say a buying range for me personally, it is paying a PE ratio between 0 and 30. I only invest in profitable companies, but I would prefer to buy between 0 and 20. PE ratio above 20 would be a little bit expensive, so you need good quality. So yeah, before you buy a stock, check the competitive advantage, check the competition, check the guidance and see if you can trust it, check the potential risks and the valuation. And that's how you can reach your goals in the future. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.